There's one subject that we need to talk about, the fear of companies with high pledge shares, which began after the SL Group promoters failed to bring fresh shares as collateral to make up for the slump in prices of the group stocks. That fear continues to cast a shadow on investor sentiment, especially for debt fund investors. Pranab Haldia, who's the MD of Prime Database, joins us now with his take. Pranab, hi, good morning, and thanks so much for joining us. You know, for debt fund investors, the bad news just does not seem to stop. So after the IL&FS blowout that took place, now we have issues like the SL Group company issue, then the Diwan housing issue. I know one need not cause panic at this point in time, but what are the red flags that debt fund investors need to be aware of when investing, and how do you sort of, safeguard yourself from these issues?
Well, the broader rationale for debt fund investors, depends on the risk that they're willing to take. So, of course, at the lower end of the risk curve, you have your liquid funds, which are fairly secure. But the main problem has arisen primarily on account of credit opportunities funds and funds of that variety, which are promising higher yields to investors. And, to get those higher yields, of course, there's a higher risk element which is involved. And which is what you've seen in the recent past with these structures, wherein a lot of bonds are issued by various promoter entities of these groups, and these are invested into by mutual funds. Now, given what you've seen recently, that whether it's in case that there's just been some rumor mongering which has led to a correction in the stock price, or even in case there's just a broader market fall, it puts the lenders or investors in a very sort of a tricky situation, because the borrower has to immediately put up more shares as collateral, or to respond to the margin call. In case they're not able to do it, it can lead to a complete spiraling down of the stock price, which in the worst case scenario can also lead to a change in the management. So all investors need to be very, very skeptical of this aspect.
So Pranav, I was just checking some numbers, and correct me if I'm wrong. Apparently, according to Prime Database data, promoters of 195 companies on the BSE have pledged 50% or more of their holding. So that's the extent of this. Now, are there any thresholds that you'd recommend to investors that, if there's a company where promoters have pledged in excess of, let's say, 50 or 60% of their holdings, and to stay away? Does that even work? How can you sort of put the checks and balances in place?
Well, yes, definitely. I think that's one of the first signals that investors should look at, which is the level of pledging. Let's be very clear that, promoters look at pledging as a, last resort, when they're not able to raise equity or debt, as per terms which are comfortable to that. So it's really a case of a last resort sort of fundraising which is there. At the same time, what is now required is also more sort of regulatory disclosures in this regard. Something which I've been recommending as well, that so in a lot of transactions such as this, you do not get to know who are the mutual fund investors who are really investing in the transaction. In a lot of disclosures which are made by the promoters, you only get the name of the trustee who's involved in that particular transaction. So one tangible effort needs to be made in that front. At the same time, I do believe that the regulator should also come up with some sort of guidelines in terms of placing a maximum amount of limit to which promoters can pledge their shares. Whether it is 50%, whether it's 75%, but you need to sort of arrive at a top limit. You have seen several cases, several companies, even today as we speak, wherein the entire promoter holding is pledged. So, in case there is any adverse news on the company or a broader market sell-off, you could see, spiraling down of the stock price, which I was saying earlier can also lead to a change in the management. So there need to be a few more disclosures which need to be mandated as far as promoter pledging is concerned. The other is also in terms of disclosing what is the amount of loan which has been taken. So what is not available in the public domain is what is the haircut margin which has been provided in such a sort of a transaction. So I think having that information in the public domain would also be a positive move.
But how do you secure yourself from a lot of debt funds? In general, debt funds offer a lot of diversification, but there are some funds that are known to take very high exposure in instruments issued by one single entity. In that case, there is a possibility of a higher blowout or a bigger default that could wipe out entire gains in just a couple of days, as we had seen with the IL&FS issue as well. How do you secure yourself from such a situation?
Well, you know, the regulator has taken a couple of moves in that direction. So one, as we already know, there are limits which are, you know, applicable for all mutual funds and schemes in terms of the exposure that they can have to a particular company or to a particular group. At the same time, even after ILFS, the recent guidelines that you've seen in terms of side pocketing of certain portfolio companies is something which is in that regard. So, you know, the regulator has taken a couple of steps in terms of, you know, promoting more diversification in the portfolio and avoiding such concentration risks. But at the same time, investors do need to, you know, look at mutual fund portfolios and, you know, avoid schemes where there's a heavy concentration towards a particular group or promoter entity.
Okay, well, we leave it at that. We've actually run out of time, but this is a very interesting discussion on how to secure yourself as a debt fund investor from, you know, many of these hazards.